What I'm going to do today is give you an overview of what is called the FairTax. I'm going to preface my remarks by telling you why certain people like it and why other people don't like it. And I'm going to tell you why I like it and what parts of it I don't like about it. There is an actual bill. You can go to the website, Americans for Fair Taxation. You can easily download the actual bill, read it. Unlike the 60,000 or so pages of the current federal tax code, I think this bill might have 20 or 30 pages. I'm not quite sure. But let's press on and see what we find. Not a single year goes by that the rules don't change. That's a fairly astonishing statement in and of itself, is it not? Not a single year goes by that important provisions of the United States federal tax code do not change. That's incredible to me. That makes me wonder if somebody has a motive. Does it make you wonder that too? Maybe I'm just cynical in my old age. Could you imagine a tax system, though, that would allow you to keep 100% of your gross pay, or your gross pension, or your gross Social Security check, at least 100% of, aside from whatever states might do to you? Should make that clear, that states, of course, are taxing entities and so are municipalities, but at least from the federal point of view, there would be no deductions for either income tax or payroll withholding taxes. There would be no deductions for anything from the federal level. Can you imagine a system that frees up all the time that is used filling out IRS form? Their compliance costs, let's call them that, cost of compliance, okay? Can you imagine a tax system that makes taxation of income unconstitutional again as it started out? The original Constitution did not allow for what we call an income tax at the federal level. That became constitutional by somewhat dubious passage. I say somewhat dubious because, as I've mentioned before, there's some dispute about whether or not the 16th Amendment was ever properly constitutionally ratified. Never mind whether it was or not, we got it. The 16th Amendment provided for federal income taxation. Can you imagine a tax system that completely untaxes the poor up to whatever the defined poverty level is through what's called a prebate? Not a rebate, a prebate. I'll go into some more detail about that in a minute so that you'll properly understand it. At the end of class last time, Jake asked me about a question that one of his friends had asked him about in talking about the fair tax and retail sales tax. Jake's friend observed, well, that's a very regressive tax, and of course, what's the notion of regressivity again? Well, it's always reckoned with respect to income, and if your tax rate does not go up as your income goes up, then that's said to be a regressive tax, right? It's a regressive tax. And of course, the fair tax does not call for an increase in tax rate that's tied to one's income. As we're going to see in a minute here, I think we'll see that the fair tax turns out not to be regressive at all because of this feature that was written into the actual bill called a prebate. We'll explain how that works in a minute. Can you imagine going on a tax system that actually would reduce tax evasion? Now, tax evasion, one of the things that people bang on the fair tax that are against it, they say, well, you'll have a lot of tax evasion. Well, I want to point out that we have plenty of tax evasion right now, and that under the fair tax we would have far less. That's just simply an illegitimate argument. Nonetheless, does anybody know what the estimated size of the underground economy is, for which there is no payment of federal income tax whatsoever right now?
And I wouldn't even try to put a number on it.
The last number I saw, which has been several years ago, so if someone set out to estimate it today, it would probably be 2 or 3 times that, who knows what, was $1 trillion. $1 trillion. Now, that's a lot of tax evasion. Okay? So in any case, can you imagine a system that would actually lower both marginal and average, or what are called effective tax rates, for low-income and middle-income Americans. Can you imagine a tax system that, in the end, when all the dust had settled, would likely cause the retail prices of goods and services to fall anywhere from 20 to 30% of what they are today? Now, we'll have to talk about why that would probably be the case, why that would happen. Okay. Can you imagine a tax system that encourages families to save more for home ownership and education and retirement instead of penalizing them when they do? I can imagine a system like that. Well, it goes on. This system, if you can imagine it, would leave funding for Social Security and Medicare untouched. This doesn't have anything at all to do with what you spend money on. FairTax is about how you collect it. It doesn't have a thing to say about how Congress would spend federal tax revenues. FairTax addresses how Congress would tax. And of course, FairTax does provide for eliminating FICA tax and Medicare tax and any other tax at the federal level. There would be no federal taxes other than the fair tax under the provisions in the bill. Can you imagine a system that would leave unchanged the amount of money raised by the federal government? It's just a question of where you set the actual tax rate as to whether or not it would collect the same quantity, same volume of taxes that the current system now does. As it has been designed and researched and proposed, it was designed to be revenue neutral. It's not a bill that says let's reduce taxes. It's not a bill that says let's raise taxes. It's a bill that says let's get rid of the federal income tax and replace it with a national retail sales tax, which is, again, I say what I wish this were called, because it's less normatively loaded to call it just a national retail sales tax. Whether you think it's fair or not is up to you. Some people would think it's fair. Other people would not think it's fair. I think it's an obfuscation and a confusion to even introduce the word fair, personally. This tax would also, this scheme, this plan, would level the playing field for American products overseas. As it stands right now, we compete at a disadvantage with foreign production. And the reason why is because our federal income tax that's paid by corporations, the corporate tax, you see, corporations, remember, have to pay taxes. But we've already learned that corporations don't pay taxes, haven't we? So what happens to the prices of goods and services of corporations that produce goods and services that are then taxed? It gets embedded in the price. And to the extent that other countries do not have a federal income tax that has as high a rate, or they don't have one at all, that causes the relative price of American-produced goods to be higher than equivalent goods produced in other taxing authorities. Okay, so moving along. Is all that possible? That's a tall bill of goods, isn't it? All that imagining. Would that be possible? I would say that it is possible. That is to say, it is feasible. Is it likely? It's a different question. It wouldn't be easy. Does it have zero chance? No, it's not zero. It is possible. I don't think it's probable, but it's possible. Over the past now 2 decades, probably at least 15 years, there's been a lot of research done. It's been paid for by the Americans for Fair Taxation, which is the grassroots organization, to research what would be the case if we had the fair tax and how things would change. It turns out that most professional economists, that would be academic economists and business economists, card-carrying economists, as it were. Actually, we don't have a card, but most And I say most, that's a sort of loaded word. What does most mean? Oh, I don't know, maybe 90 to 95% of all economists agree that taxing consumption instead of income offers substantial comparative advantage to taxing income. Substantial advantage to doing that. Okay, now we found out that a straight national retail sales tax, if that's all it were, if you actually taxed all sales of final goods and services, what did we find out last time? That's not a tax on a consumption base, is it? Turns out that's a tax on income, isn't it? But FairTax is a tax on a consumption base, and we'll see why it is in a minute. Of course, the reason why it is because you must exempt certain kinds of expenditures for it to be just a tax on consumption. All right? Well, what the FairTax does exempt from taxation is savings and expenditures on education. Okay, taking that by definition to be an investment as opposed to a consumption expenditure. Clearly, some educational expenditures are consumption, but most educational expenditures are with the intent of building human capital, just like the expenditure of a business on a new machine. Okay, so it is a tax on consumption as opposed to income, and it is the case that the great preponderance, let's put it that way, of professional economists, PhD trained, master's trained economists agree that taxing consumption instead of income offers several advantages, and we'll talk about what those advantages might be here in just a minute. To be fair, though, it's also true that many economists are skeptical about the ability of our political system to ever move to a national retail sales tax of any kind. Well, they're skeptical about that, and most of them let it stand in their way of being outright advocates of the fair tax. I don't. So why should we change? What's wrong with the current tax code? Well, you and I already know a lot about that since we've just been engaged in, 15 weeks of studying something about taxes, the economics of taxation. The current tax code is certainly costly, it's certainly confusing, and some people want to say it's just not fair. Of course, other people say it's not fair. Probably everybody says it's not fair. Right? It's probably the case that everybody says it's not fair. The problem is that some of them say it's not fair because the rich aren't paying enough, and part of them say it's unfair because the poor aren't paying enough. Okay, so probably everybody says it's unfair. Because the income tax code is oppressively complex. It's not just a little complex. It's oppressively complex. I dare you, read any instruction form published by the IRS and tell me whether or not it's oppressively complex. I don't care if it just is maddening because it's written by people who evidently have legal training. Have you ever read an actual bill of Congress?
I scanned one or two.
It is absolutely oppressive. It is designed not to be understood, in my opinion. It turns out that many people don't pay as much tax as they're supposed to, even under the law, which means what? It means that the rest of us end up having to pay more than we otherwise would have if there wasn't so much tax evasion. Even the IRS itself, this isn't somebody else, this is the IRS itself estimating that over 40% of Americans evade the income tax in some way. Okay. Yes. Well, 40% of Americans who are filling out tax forms is what this really means. They're evading tax in some way. In other words, if they got audited, they would owe more tax. Is really what's going on there. Estimates say, who is Mr. Estimates? I don't know. Estimates say that tax evasion makes those who are not evaders pay over 30% more in taxes than would be necessary to raise the same amount of revenue as if there weren't that much evasion going on. Okay. So why change again? Some more. Over half of the American taxpayers seek professional help to prepare their returns. Well, that's an astonishing figure, isn't it? 50% of the households have to, I don't know if they have to, but they end up paying someone to help them prepare their tax forms. According to Money Magazine, chances are high, how high? 99%, that you will pay someone to file. If you pay someone, you're paying them to file an incorrect return. They don't get it right either. Why? Because the tax code is oppressively complex. It's mind-bogglingly complex. So even people who are being paid to do it, including CPAs, don't get it right. Well, it turns out that compliance with the federal tax code isn't just difficult, it's complicated, and it's quite unreasonably expensive. How expensive? I've seen several estimates. I used the most conservative one in the slide set. Estimates, studies that people have done to try to calculate the cost of compliance have come up with $225 billion per year. Actually, other people have come up with numbers as high as $400 billion per year. So take your pick. Let's call it $300 billion or something like that. For what? For paying and time spent on filing taxes, keeping tax records, and paying for tax advice. It's a lot of damn money. That's not, I know we throw around $1 trillion today like we were talking bananas or something. But $400 billion is a chunk of change.
It's half of what spend on Social Security outlays are like 600 and some
right.
To the top of Q&A.
That's right.
Comparison.
That's a good point. Jake makes the point that, well, it's 400 is more than half of what we're spending annually on Social Security. So this isn't chump change here by any stretch of the imagination. And I hasten to point out, it's not dead weight costs. It's real money coming out of real pockets. Whose? Yours and mine. That's the equivalent of about $850, if you take the $225 billion number, $850 per head in America.
$850?
To get it wrong.
Per person.
Yes. Something like that. We have taxation without comprehension. It's not taxation without representation. It's taxation without comprehension. Nobody can say that they understand federal tax law. Nobody. And nobody pretends that they do. The current income tax code really does hamper personal financial opportunity. We've already learned that at least in the short run, when you make a change to tax laws in the short run, and you tax wages, what does that do? Well, that potentially reduces people's incentives to work extra hours. Now, I've argued that that's probably not what really happens in the long run. It may not even happen in the short run, but at least theoretically it could do that. The current federal tax code retards economic growth, capital formation, and therefore job formation. How does it do that? Because the current federal tax code taxes returns to capital investment. It taxes savings, doesn't it? If you save $1 and you earn income from that savings in the form of interest, you get taxed on the interest. If you save $1 and you do so by purchasing some real asset, and that asset has an increase in its market value, that's called a capital gain, you get taxed on the capital gain. I think that Robert Lucas has made the analogy, and he doesn't favor, he's a Nobel Prize winner, in case you didn't know. Robert Lucas, an economist, has argued that taxing capital gains is similar to sawing off a limb of your apple tree. Right? The apple tree grows, right? Has more productive capability, so you saw one of its limbs off. That's what taxing capital gains is like. Taxing investment income, that is to say, dividends paid on shares of stock or interest paid on bonds or interest paid on any interest-bearing financial instrument, reduces household saving. Other things unchanged. Does it or does it not? Can you actually retard savings by taxing investment income? Can you actually retard work effort by taxing wages? Well, to use the jargon of economists, that would depend on the elasticities, which is to say, who the hell knows, right? Since elasticities are not constants, it's not like gravitational constant or something that you could actually go measure and then rely on it being that, even though that's the way they get used in every economic model I've ever seen. I have little respect for those kinds of models these days. You probably picked up on that in this course. But in any case, we don't know for sure whether taxing investment income actually reduces household savings. It could go just the other way, couldn't it? It could go that if you tax my investment income, I'll have to save more because I'm saving for a reason. And I need to reach that reason. I need to get that much money piled up together in the same spot. Like my retirement, for example, right? Or like to buy that new house that I want to buy. I'm saving for a down payment. If you tax my investment income, I just have to save more. I do have to get my down payment pulled together. Do you see what I'm saying? All this nonsense that we teach in one or another economics class about, well, what if the supply curve looks like this and the demand curve looks like that, and an elephant doesn't fart in Africa, well, then you would have this much reduction in savings, right? You probably wonder why I threw the part in about the elephant. See if you can sort that out.
I'm just thinking that you forgot to multiply by the cost of eggs in China.
That's right. I threw the part about the elephant in because it had as much to do with the elasticities of the supply and demand curves. Had every bit as much to do with it, is why I threw it in. Some investment earnings are subject to double and even triple taxation. This is the case of dividends, for example. If you own a share of stock and you get paid a dividend on that stock, that's at least double taxation, and depending on what you do with the money, it might turn out to be triple taxation. I never get too exercised about whether stuff is double taxed, triple taxed, quadruple taxed, or whatever. Who cares? That's a rhetorical device to talk about being double taxed. Oh, that's horrible, it was double taxed. Why is that any more horrible than being single taxed? I don't know why that is. It isn't, actually. So this is just a rhetorical point to appeal to people who don't think that deeply. All right. Taxation is taxation. Who pays taxes? People do. From whence cometh the funds? Their current and past income. In the story, what else needs to be said? Hardly anything. Hardly anything. Well, how does the FairTax work? Let's rehearse some of that, so that we'll at least have learned something today that you can take to the bank, right? You can know it's true. Some of the things I tell you, you can't actually know that they're true, because I don't actually know if they're true, but you'll have to think about it yourself. It is simplicity, that's for sure. Paying a federal tax like the FairTax would be even simpler than paying state sales taxes are today. And the reason why is the FairTax would apply to all purchases of new goods and services only once at the point of final retail sale. That's to say, at the cash register. Okay? State taxes on sales. Now, some of the states, they're fairly complicated. Depends on what you're buying. Depends on what you say you're going to use this for. I mean, all kinds of things, right? If you go by the FairTax, well, if you go buy a banana, you're going to pay a sales tax on buying that banana if it's a final sale. The FairTax provides for government to pay tax at all levels, including the federal government, on purchases of final goods and services. Right? And some people have taken me to task personally, and others have taken the FairTax to task about that in general, saying, well, that's saying government pays itself. Well, maybe it is. Who cares? Government pays taxes on income it pays to its workers right now. Also, it's nothing new. And there is an economic reason for that. The reason is so as not to distort relative prices as between purchases made by governments and private citizens. If you don't have governments pay a sales tax, then they have a lower relative price on anything they buy compared to people that aren't deemed to be, quote, government.
What about if you purchase like a share of stock?
If you purchase a share of stock, that's savings.
So it's not taxed?
That's not tax. On the other hand, if you pay a registered investment advisor to help you buy that share of stock, you will pay a tax on that service. That's a final good or service. No individual tax returns or tables or schedules, because there is no individual taxpayer paying tax based on income. There would be no audits necessary. You wouldn't have to audit individuals. You wouldn't have to tell individuals that they have to reveal all the details of their financial life to you, which is what the IRS does right now, which in my opinion and the opinion of any number of other people is a violation of the Fourth Amendment to the Constitution. We allow the IRS to abuse us routinely, in other words, in ways that we do not allow any other institution to do. We would sue them. We might even have a class action suit against them. But when it comes to the IRS, they can tell you that you must tell them everything about your matters financial. Is it not so? Well, under the FairTax, there would be no need for that. There would be no call for it. It just wouldn't be done. There wouldn't be anything for individuals to keep records about. Why? Because individuals would pay their taxes when they bought stuff at the cash register, just as I say. Fair tax would be automatically applied to new goods and services you buy, and it would appear clearly on your sales receipt. But you'd be able to see how much I'm being taxed. What am I paying here in taxation every time you bought something? Used items would not be taxed, nor would purchases of businesses. The retailer, who would receive an administrative credit, as it's called, for collecting the fair tax. So in other words, you're going to pay them, not asking retailers. States don't do that, by the way, now. If you are in business, in a retail business, and you're selling stuff, the state pays you to collect the tax.
You can.
No, I'm not kidding. Yeah, they pay you a percentage. Because it's not a, that's not a free good, collecting taxes.
No.
Keeping records and showing how much sending money in, all that's work, right? Why shouldn't the state pay for that? Of course, they should, and they do. Well, under the fair tax, retailers would receive a payment for collecting the fair tax. They'd simply deliver the tax to the state taxing authority, just as retailers do now in 45 states today, at least in 2005. It may be different today. There were 45 states who used a retail sales tax at the state level, and that's the way it works. Retailers collect the tax, and they submit the tax, remit the tax to the state, and the state pays them. You're not going to get rich for what you get paid, but it's a reasonable amount for the service rendered. In fact, the fair tax calls for states themselves to receive a payment for collecting the federal tax if we have the fair tax implemented. The taxing authority then sends the funds to the United States Treasury. That would be the individual states' taxing authorities. Politicians would no longer be able to use the tax code to favor or restrict particular goods and services, or to reward or punish behavior to benefit special interests. That alone is worth its weight in gold, from my opinion, from my point of view. Denying the political class the tool of interfering with voluntary exchange offers enormous benefits. Now, some people would argue that's why we call it the fair tax. Okay, fine. If that's what you mean by fair, that's fine. anytime, you know how I feel about it, I don't talk about it in terms of fairness. I talk about it in terms of what's moral and what's not moral. The fair tax would, in fact, reduce political power substantially. That doesn't, now you know why you're not going to ever see it passed. Unless what? Unless we rise up with pitchforks and torches and say, you will do this, or you will not be a politician.
Like what happened in this last election.
That's right. That's why I'm waiting, as they say, with bated breath. I have no idea what that means. Never researched the etymology of bated breath, but I'm waiting with it to see whether or not the Tea Party movement has legs. Because if it does, we might just see the fair tax finally implemented. We might. We'll see. On slide 514, as it's labeled, tax rates with the fair tax, at least effective tax rates. The marginal tax rate's constant, and it's based on sales. But the effective tax rate, that is the average tax rate, reckoned with respect to income, will be lower than it is now for many people. How so? Well, here's how so. There's a picture on slide 5-14, a graph that if you take a two-earner family that spends all its income with both spouses earning similar income from wages only. Okay, so this is a particular case. Here's what you would have. A family earning $30,000 of income under the current income tax, which includes the payroll tax now. Remember that. The payroll tax is a regressive tax for sure, right? Because it's the same tax rate regardless of one's income. Well, they're paying a bit above, it looks like 16, 17, maybe 17% is their average tax rate. Under the fair tax, their average tax rate would be a bit over 5%. So that's how you read this chart. So it continues to be the case all the way up to $100,000 a year, even, that the effective tax rate, the average tax rate, and just divide the amount of taxes you paid, which includes your federal income tax assessment plus your payroll tax assessment, divided by your income, that's your effective tax rate. All the way up to $100,000 a year even, the average tax rate would be less with the fair tax. How is that possible if it's going to be revenue neutral?
That's what I was wondering.
Well, there's only one possible answer. The base of the tax must be much larger, right? And it would be. The base of the tax would be aggregate consumption, wouldn't it? The base of the federal income tax is less than aggregate consumption in the United States per year. The federal income tax that we currently have, with all of its tax preferences, exemptions, etc., that tax base, the adjusted gross income, in other words, the amount that you actually pay taxes on is far less than aggregate consumption in the United States. Let me put this in easy terms. The fair tax broadens the tax base. What people would end up paying taxes on is a larger base than what they currently pay tax on when you consider the whole United States tax code. Okay? That's the only way you could collect. Plus, I might say, plus the tax rate that would be used on retail sales under the fair tax is, and this is a little bit of a complication, it's either 23% or 30%. And you say, why is it either or? Because one can calculate a tax rate on sales two different ways. You can either calculate the tax rate in such a way that you subtract from the base, the denominator of the calculation, the amount of the tax, right? So you have the amount of the tax divided by the amount of the sale minus the tax, That's called a tax-exclusive calculation. Or you can have what's called a tax-inclusive calculation, where you include the amount of the tax in the sale itself. So let me give you an example. I know there's a complicated set of words, but let's give an easy example. Suppose you buy something that costs $100. All right? That's its price. So you go down to the store and say, I want to buy this, it costs $100. And the retail clerk says, okay, that'll be $106. You say, wait a minute, I just thought it was $100. So, well, no, there's a $6 sales tax, right? $6 sales tax. Now, what is your tax rate?
6%.
That's if the denominator is 100. Well, what if the denominator is 106? Where you include the tax in the base of the calculation. 6 divided by 106. I don't do those kinds of things in my head, but maybe you do. It's less, of course. It's a lower rate. So, depending on whether you calculate the tax rate that would be revenue neutral as a tax-inclusive or a tax-exclusive tax rate, you either get 23% or you get 30% to give you revenue neutrality as compared to our current federal income tax. Okay? And payroll tax. So that's a complicating factor. Everybody gets their panties all in a wad about it, that they're not mathematical at all. You say, well, why would you ever want to divide by 106 instead of the 100? Because that's the way you calculate income tax rates. If you pay an income tax, where do you pay it from? Your income. So how do you calculate an income tax rate? Is it tax exclusive or tax inclusive? Included, isn't it? You say, my federal income tax rate, my average income tax rate at the federal level was 15%. What's in the base of that calculation? All of your income. But all of your income includes the part that you sent off to the government as the tax. So it's a tax-inclusive calculation. If you were going to try to make a comparison, which is ridiculous in the first place, mind you, why would you want to make a comparison between a sales tax and an income tax? You shouldn't want to make a comparison between those rates since the bases are different. That's an invalid calculation in the first place. But I'm just wanting you to understand the difference between a tax-inclusive and a tax-exclusive rate calculation. Yes, Jack? This is a pretty much who cares argument. It's a technical argument that I say people get all balled up about and say, well, I don't like the fair tax because you're lying about it. You say the tax rate's 23%, but it's actually going to be 30%. That's a lie. That's the way people think. I'm sorry, that's just the way people think. Because what? Here's what would happen. You go down to the store, you buy $100 something, costs $100. You would fork over $130.
Yeah.
People say, see, 30% tax rate. And then I would say, yes, by a tax-exclusive calculation, but if you make a tax-inclusive calculation, it's going to be 23%.
Which is like 30 over 130, right?
Yes. See, 30 over 130, do the math. 30 over 100, do the math. You get two different tax rates. The same $30 was paid in taxes. You see? Just as Jake said.
I don't even care about that.
Okay, what do you care about?
Revenue that the government would actually take.
Yes, by adjusting the tax rate on sales of final goods and services to the right number, you can get the same amount of federal revenue collected as the current income tax code. Studies have been done to determine what tax rate on sales would do that. The studies show that on a tax-inclusive basis, it's 30%. On a tax-exclusive basis, it's 23%. But since there are two different ways to say how we're calculating the tax rate, just forget all that. That's immaterial. If that's bothering you, forget about it. Do you see that by adjusting the tax rate on retail sales to some number, you could collect the same total tax collections as our current federal income tax code? Do you see that?
And that doesn't even include state taxes either.
No, we're not dealing with states here. We're talking about federal taxation here, not states at all. States aren't involved in the fair tax, except as tax collectors.
So how does the incidence change?
Tax incidence, okay. Who bears the burden of taxation under the fair tax? Clearly, people do. Which people? People who buy final goods and services.
Which is most.
Let's see, that includes everybody but grandma. Oh no, it even includes grandma, doesn't it? It includes everybody that buys final goods and services.
How does that change from what we have now?
But what we have now, it's impossible to say who bears the burden of federal income taxation right now, isn't it?
Some don't pay. Some
It's impossible. Why is it impossible? It's impossible because they keep the tax code in constant flux, which means that short-run incidence changes from year to year. We never get to the dust settles. We never get to a long-run equilibrium because the tax code is in constant flux. Who bears the burden of federal income taxation right now? Nobody knows the answer to that question, which is exactly the way the politicians like it. Warren Buffett claims that his secretary bears more tax incidence than he does. Remember that? Who knows? Nobody knows is the simple answer. Under the fair tax, everybody would know what incidence of taxation they were personally bearing, wouldn't they? Which is part of the reason why politicians don't like it. Here's an example. Maybe, we'll see. To illustrate the effective tax rate, let's take a couple with combined wages of $30,000. They pay $2,295 in payroll taxes. That's the employee share of the 15.5% payroll tax. And $2,558 income taxes for a total of $4,853. When you add the rest of the payroll tax, which their employer withholds from their paycheck, the total tax that they pay soars to $7,148. Okay? Just because the employer remitted it doesn't mean the employer paid it. He just remitted it, so that's why we added in. That's more than a 20% effective rate on their income measured on a tax-inclusive basis. Okay? Under the fair tax, that couple would receive an annual rebate. It's actually a prebate because they get it at the beginning of each month in the monthly installment of $3,841. In other words, they're not paying the $7,148. I mean, under the fair tax, the couple that's earning $30,000 a year would get paid to them from the federal government $3,841 in 12 equal monthly payments that they get at the first of the month.
And
why do they get paid for that? Because the fair tax inventors understood that a lot of people would say, this is very regressive. And in fact, what would happen is every taxpayer, every household would get a check to reimburse them for taxes they're paying up to the poverty level.
So you give them money after you eat.
Whatever the defined poverty level
The
is.
wages that they have up to the poverty level will be taxed.
You're not taxing wages anyway. You're taxing their expenditures on final goods and services.
Yeah, but that's how you're measured.
How do you know how much is in it?
You know, it isn't based on their income. So you're not understanding yet. It doesn't matter what their income. Even if this couple, this imaginary couple, making $30,000 a year, spent every penny they earn on taxable goods and services, which is unlikely. They might buy some used goods and services, for example, or they might do some savings. Their sales tax bill, including the rebate/prebate, since you get it in advance, would be $3,059, or just 10.2% measured on the same tax-inclusive basis.
Did we say what their income was?
$30,000.
Okay.
Now, here's a table on slide 5-17 that shows in 2004, which is quite a while back now, what the rebate calculation would be. It depends not on income, but on family size. You see? So, if you were a household of one person, the Human and Health Services annual poverty level in 2004 was $9,310. The fair tax annual consumption allowance for a single person would have been the same. The annual rebate for a single person would have been $2,141. So if you divide that by 12, you get $178. Okay? And since this person's not married, you don't have the allowance for two people. The annual rebate for a married couple, blah, blah, right? So you see how to read the table. If your family size is 2, you and your spouse, the HHS poverty level in 2004 was $12,490. So that's the FairTax annual consumption allowance. In other words, you don't pay the FairTax on the first $12,490 of your consumption expenditures. You get it rebated to you. You pay it at the cash register, but they send it back to you. And in fact, they send it back to you before you buy. Based on what? That you're a household of size 2. So each month, a man married to his spouse, let's imagine she was even a woman, would receive at the first of the month $239.
$210.
Willy-nilly, $239. Here's your check. But wait a minute, does it? What if I'm making $100,000 a year? Here's your check. What if I'm making $2 a year? Here's your check. Based on what? How big your family is. That's what keeps the FairTax from being regressive. And that's what keeps, in fact, the average tax rate compared to our current tax code actually lower for households all the way up to even $100,000 a year. Their effective tax rate, which is the real thing that matters, how much are you paying in taxes, is what really matters to people, doesn't it? Do you think people who behave the way economists imagine, some economists, not this one, some economists imagine them to behave, respond to their marginal tax rate? Do you think that describes human behavior very well? I think it describes human behavior not at all. I think what matters to me is how much taxes am I paying? I don't really give a damn what the tax rate is. What I really care about is how much of my money are you stealing? Did he say steal? Yes, he did. All right, so on slide 518, what is the revenue neutral fair tax rate? Well, according to the studies that have been done, there have been several done, the fair tax rate would have to be somewhere between 23 and 26%. There have been more than one study done on a tax inclusive calculation, which turns out to be exactly the same thing as a 30 to 35% tax exclusive if you want it to be revenue neutral. In other words, if in the year 2005 when this slide was prepared, if you had wanted to collect the same amount of federal revenue that is currently being collected or was being collected in that year from federal income taxation and payroll taxation together, you would have had to have something between 30 and 35% at the cash register tax rate if you calculated it on the basis of a tax exclusive calculation, which is the way most people calculate it. Okay? But what effective tax rate calculated on a base of your income would that have turned out to be? Well, that depends on what your income was, as we saw in that previous chart. All right, some economists say that the rate would actually be lower when the enormous potential for economic growth is unleashed over time. Now, my own opinion is that those economists are wrong. What do you save when you go to the fair tax? Are you going to get a lot more savings than we get now? Some economists want to assume that you will. Do they know that you will? No, they don't know that, but their models say that you would. To the extent they are right, you would get more economic growth. If you had more saving, you'd get more capital formation, and therefore more economic growth in the same period of time. Faster rate of economic growth. But what if you didn't get more saving? You still have a benefit. What is the benefit? You save the cost of compliance. Is that trivial? It's not even close to trivial. So I don't like, as an economist, I don't want to get all balled up into whether we're going to have much more rapid economic growth or not. I don't care. It doesn't matter to me. I still say that fair tax is better. Why? Because we quit spending anywhere from $250 to $450 billion a year on useless activity. That's why. And I get to keep more of my money to buy cheeseburgers, which I enjoy. You see? Yes, Ethan.
Over the weekend, I was actually talking to some people about this, and one of the things that kept coming up was if you didn't differentiate business to business and make it the final sale, how would you discern, say, a contractor going to Lowe's and buying materials?
Well, presumably you would do it the same way it's done now by states that have a sales tax. If you are a business person and you make purchases at what is essentially a retail outlet to buy anything that you're going to then incorporate in your business, you have a tax ID number. You have to be registered to do that. And you have to then present that card at the cash register and say, this is a tax-exempt purchase. Now, presumably, I don't know how the states do this, but it would not be difficult at all for anybody making such a purchase not only to have to present their bona fide business tax ID number, since they are a person that's exempt from paying the sales tax on that transaction. It wouldn't be difficult at all for the business selling the items to also have a notation on the invoice that this is a tax-exempt sale. And then, what do you end up having to do? Since people are people, and we know that people are scoundrels in general, at least a lot of them seem to be, you're still going to have to audit businesses to ensure what? To ensure that they are collecting sales tax due and that they are not exempting sales without a proper ID. So it's not the case that the fair tax can eliminate tax evasion. It is the case that it can greatly reduce compared to what we've got going now. So the idea that somehow we would have more tax evasion under the fair tax than we have now doesn't pass the sniff test. So does anybody actually know what tax rate would be revenue neutral? Well, not precisely. But then on the other hand, nobody knows exactly what time it is either, do they? Always like that Chicago song, does anybody really know what time it is? The answer is no, they don't. If you've got two watches, two clocks, you will never know what time it is, will you? Because they'll always say different. Why must the people lead the politicians to the fair tax? Well, the simple answer is they will not lead, the politicians will certainly not lead the people to the fair tax. If we were to have it, it will have to be because of a popular uprising of ordinary squats like you and me, who just simply tell politicians, I won't vote for you if you say you're even ambiguous about the fair tax, I won't vote for you. You have to say, I'm for the fair tax, I won't vote for you. Did you hear me? I've written both, I wrote everybody at one time or another in the Virginia political 545, and I always get letters back saying, we're taking all of your comments into consideration. Senator Warren is thinking about this, and I'm saying, Senator Warren, you don't get my vote. If you cannot stand up on your hind feet and say, I will vote for this, you don't get my vote. That's what it will take. Why? Well, the current tax code gives politicians enormous power that they don't want to give up. Let's just be honest. Most politicians will come to the fair tax table kicking and screaming if they come at all.